Gang, welcome to Money Talks. It's going to be a quick one today. I've got a lot going on, and I want to give you a overall market update. I haven't slept much the last few days. I think everybody in banking and crypto has been wide awake for quite a while. If you're a bank exec in the United States and you got a lot of sleep last night, my compliments. It has been a crazy week. Let me get right to it. I want to give you an overview of what's going on and why. The last 48 hours have not been great if you're a bank in the United States. There's widespread fear, if not yet panic, over bond market losses at mid-sized and growing sized US banks. So let's dig in. What exactly is happening? All right, so let me try to walk you through this. Then we'll do a market update, and I'll give you an update on what's going on with Bitcoin, Ethereum, how it's reacting to all of this. We got the pullback finally that I expected, not quite the way I expected to get it, but it never comes exactly the way you expect it. But believe it or not, this pullback could be exactly what we wanted. I thought we would get a pullback to 20,500, maybe 21,000. We're a little bit below that, right around 20,000. But if we continue to bounce off around 20,000 and then move higher, I think we're in very good shape. What we don't want to do is move significantly lower from here. A move down to 18.5 or actually like 17.5 or something like that would be horrible with not a lot of room below. So we'll come back to that in a minute. I want to talk about banks first. As I said, there's now widespread fear, if not yet panic, over the situation evolving in the United States within the banking system. Okay, so as you probably have heard, Silvergate Bank has basically volunteered to liquidate itself as of yesterday. Okay, and this is obviously unheralded in the United States in the last certainly in the last 15 years since since the banking crisis, and we're obviously worried. And we will see how this plays out. But a couple of things that we need to keep in mind. Okay, so first of all, banks hold less than 1% of liabilities. For a bank, your deposits are a liability on their balance sheet because they have to pay you back, all right, on demand. That's why they're called on-demand deposits. And banks hold less than 1% of the liabilities, i.e. your deposits, as physical cash, okay? These banks are way overexposed to bonds. Why are they overexposed to bonds? They're overexposed to bonds because they're basically told in not so uncertain terms that these are the risk-free ways of generating yield in the United States, along with repos and a couple of other Federal Reserve supported transactions. Now, being overexposed to bonds is fine when interest rates are falling, when interest rates are steady, moving up and down a little bit. But when you have interest rates that have gone up effectively, let's say that the rate is 0.1% or 0.2% is the effective bank rate, even though it's closer to zero, right? And you go to 5%, right? That is 25x increase in the funds rate. We have never had an increase that fast, so that high in recorded modern history. Okay, that is problematic for banks. These rising rates. Now, remember, bond prices move the opposite of rates. So rising rates means falling bond prices. Now, if a bank has a liquidity crunch, what's a liquidity crunch? A liquidity crunch means that a lot of people are asking for their money out of the bank. But remember what I said, the bank only holds, like, let's say 1%. Let's give them the benefit of the doubt. They hold 1% of your collateral or your deposits as live collateral. Okay, that's problematic when these rates are falling as they are now, which means falling bond prices, because when everybody's trying to withdraw their funds at the same time, they're forced to sell these bonds as well as other assets that they may be holding, right, such as mortgage-backed securities, and they have to sell them at a loss when interest rates are rising this fast. And banks have unrealized losses, which we'll come to in a second. But you can see here via this Fred chart. Let me zoom in a little. I can figure this out. There we go. Right. The amount of treasuries that the banks have put on their balance sheets, you can see here the chart goes vertical, right? In 2020, it's fallen back a little bit, but the amount is still in the trillions of dollars, right? And so the amount of losses that are going to have to be covered is staggering. And someone has to cover these losses. The only options are the shareholders of the bank, clients of the bank, or the taxpayers, or effectively the bank goes bust, which is what we more or less saw with Silvergate. Now, Silvergate is going to be able to pay everyone, which we'll come back to in a second as well. But most banks are affected by this as they all do exactly the same thing. They buy treasuries. Silvergate went into liquidation after Senator Warren caused a run by tweeting that the bank was insolvent. But by this measure, no bank is solvent. Any bank that has a mismatch between everyone asking for their funds immediately and long dated treasuries, which have unrealized losses, is insolvent. Okay. So the question becomes, how far and wide does this problem go? Well, let's take a look. Silicon Valley Bank is up next. Silicon Valley Bank, for those of you who don't know, those of you who don't live here in Silicon Valley, is the most important bank for startups in the United States. They provide liquidity, they bank venture capitalists themselves, they often extend credit to venture capitalists when venture capitalists need to make capital calls in order to fund investments, and there's maybe a delay in getting that funding. Anyway, they are the bank of Silicon Valley, the bank of startups. They have competition, but they're the bank, okay? They are the number 18 bank in the United States. Their venture capital clients, the companies that store their own funds there, are telling their investments, their startups, get your money out of Silicon Valley Bank. That means that a run on SVB is underway right now. Okay. And again, as the number 18 bank in the United States, the Fed cannot let them go under. They'll be forced to step in if investors of the FDIC does not. As right now, it appears that investors are stepping up, but as of this morning, it also appears that they're trying to sell themselves. And that's potentially problematic, as generally you need permission from the Fed to find a buyer, which means they'll probably not approve smaller mid-sized banks merging with Silicon Valley Bank, because those banks are probably suffering from the same contagion related to treasuries and mortgage-backed securities as Silicon Valley Bank is suffering itself. Problem. Okay. So what that means in English is the Fed would want to see a large bank, a Citibank, a Chase, a JP Morgan, et cetera, buy Silicon Valley Bank. And right now, given that they're probably sitting on unrealized losses themselves, unless they're getting a cash infusion from the Fed or the US Treasury, a la TARP, they're not going to want to do that. Okay. Now, as I said, we don't know how far this bond contagion and these unrealized losses go in terms of which banks, but the problem clearly extends far and wide. And as I showed you in this chart here, we can already see that we're approaching, $1 trillion in unrealized gains. Unrealized losses on these investment securities. And if they were held to maturity, the losses would be massive, and it's getting worse. Okay. Now, today, of course, because there's an expectation that somebody's going to step in, bond yields actually fell. Which means that the bond prices went up, which probably helped them temporarily, right? But as I said, we don't know how far and wide this goes. But if the contagion truly sparks a crisis, as it appears it's going to, the Fed is going to have no choice but to work with Treasury to bail out the banks, which is what they did under TARP back in 2008, 2009. And that means more quantitative easing and effectively lower interest rates, because the Fed would be forced to buy bonds. But, and this is a big but, right? This leads to another problem, okay? Right? The Fed has a $1.5 trillion mark-to-market loss because it's been buying treasuries and mortgage-backed securities, right? So for the first time in 107 years, and this is a fantastic tweet storm from Ram Aluwalia, who I follow religiously on Twitter, and you should as well. I'm going to go over this with you. But for the first time in 107 years, right, the Federal Reserve has negative net interest margin. NIM, or net interest margin, is effectively the difference between what a bank earns on yield, right, and its cost of capital. right? So these losses are poised to exceed its capital base. That is insane. Quantitative easing meant that the Fed was buying these long duration mortgage-backed securities and treasuries at higher rates. The rates have increased by their own doing. The Fed is sitting on a 1.5 to 1.3 to 1.5 trillion dollar loss on this portfolio. That is a staggering number, but it gets worse. The Fed is losing money for the first time since 1915 and has 8.3 trillion in fixed rate bonds earning only 2% on the asset side of its balance sheet. That's the biggest driver of Fed earnings. But they're paying out variable interest on 5.7 trillion. Hence the negative net interest margin. So the Fed owes payments on bank reserves and reverse purchase agreements. What happens when rates rise? Again, double whammy. The Fed's bond portfolio declines in value, right? The hold to maturity portfolio has a huge loss and it has to pay out more, right? So it just keeps getting worse and worse and worse until the interest rates get lowered or the rates that they're paying are under control. The Fed's interest expense increased 18x, 18-fold from 5.7 billion to 102 billion. That's last year. Okay. This year is poised to be worse. The Fed's earnings flipped to negative in the fourth quarter, and we're going to see more negative earnings so long as rates are above this 3% threshold, right? So again, what's the break-even rate that causes the Fed's earnings to go negative? And by the way, this is a good indicator for the banks themselves. The banks aren't efficient as the Fed, meaning they're not as efficient as making money and they're not as efficient as losing money. But by and large, the break-even rate is going to be 3%, which they've exceeded since September of last year. Right? So the higher the Fed fund rate goes, the more losses the Fed will incur. So the Fed is effectively insolvent. Let me repeat that. The Fed is effectively insolvent. Now, you can make the case that, of course, the Fed can just create IOUs for itself and address the issue, right? As it does in quantitative easing. The problem with that is it will drive down interest rates, which will most likely cause more inflation. You get it? You see the conundrum here? You see the problem? The Fed is in a no-win situation right now of its own doing, right? So the Fed remits excess earnings to the US Treasury. In September, this flipped negative and is increasingly negative each week. They're losing $2 billion per week, and that number increases with higher rates, and they're poised to increase rates between 25 and 50 basis points very, very soon, right? They have total capital of 43 trillion. But if you lose, say, 2.6 billion a week times 50 weeks, you get 130 billion in losses in 1 year. That's 3 times their capital base. Right? But the Fed has a very clever accounting trick, as I mentioned earlier, so you won't see the capital actually technically go negative. If they book a loss in a given year, it would have no profits to remit to the Treasury. But under the Fed's accounting rules, it would accumulate a deferred asset equal to its cumulative losses. So you see where this is going, right? They just basically create like a little side pocket, almost like Enron, a little balance sheet for themselves. They have a deferred asset in there, which are these accumulated losses. So once they return to profitability, right, they retain profits to pay down this deferred asset, which are the losses that they're accumulating. So the Treasury is basically financing the Fed. It turns out that the lender of last resort has its own lender of last resort, and guess who that is? It's you and me. We are the lender of last resort of last resort. So, all right. So on January of this year, the amount owed to the Treasury was 20 billion. The Fed did not pay the 20 billion because the Fed is unprofitable. That number is going to grow probably 2 to 3 billion a week for the rest of the year until the Fed starts lowering rates, right? Now, the Fed can hold to maturity all the bonds it purchases, but at some point, they're going to have to pay the piper, or we are, as they say, all right? So I'll stop this share. Look, this is not a great situation, and there's no easy way out. And yeah, so it's not good, folks. And this has nothing to do with crypto. So when I see Silvergate go under because a senator, let's say unethically tweets that this bank is insolvent, which is what happened with Silvergate, I have to ask myself, Bill, you've been around the block. This smells like wag the dog nonsense because somebody's trying to force us to take our eye off the ball. And the ball is the fact that these banks are mostly insolvent right now, if there was a run of any meaningful kind, because of they're sitting on tens or in some cases hundreds of billions of dollars in unrealized losses on these treasury portfolios they were forced to purchase, because these are the safe haven assets for the banks. It turns out there are no safe haven assets for the banks except 100% reserves, right? Which is not the banking model in the US. Now, ironically, 100% reserves is the model that Custodia Bank, right, Caitlin Long's bank, was proposing to the Federal Reserve when the Federal Reserve denied their application to become a member bank. How messed up is that? So the one bank where we know for certain that this problem can happen because the bank was set up to not do fractional reserve banking or lending was denied membership in the Fed. And yet Elizabeth Warren goes in front of the television, tweets that crypto is dangerous. Crypto is not dangerous. These people are dangerous because they don't understand the system that they're regulating, or they're in denial, or they want the public to be in denial over the effects of their decades of mismanagement, right? And I kind of get that, right? You get to the point where you can't have a panic, right? So you got to continue the lie. But I'm here to tell you that they're lying to you, and there is a way out of this, right? So anyway, let's take a look at the effect on the markets. And so let's bring up our Bitcoin chart here, and I'll show you what's happened. We have basically a jobs report this morning. Now, the jobs report generally moves the market, and it did. It moved the market, but ironically, right, we were in such a crazy place that it's really the banking story that's moving the market today, and the market has mostly shrugged off the unemployment news. Okay, and the unemployment news, just to kind of summarize, right? So we had payroll increase of about 300,000 versus an estimate of 225,000. And the unemployment rate actually went up, I think, from 3.4% to 3.6%. Anyway, and so yeah, this is not a big deal relative to what's happening with the banking sector. And I have a feeling that you're going to see at the most a 25 basis point hike. If this gets worse over the next 3 or 4 days, that goes to zero, in my opinion, meaning they stop hikes because they're afraid of worsening the losses. Okay, we'll see. But right now it is ugly. UGLY is the word of the day if you are a United States bank. As a matter of fact, if you're a Western bank, if you're in Europe, if you're in Canada, maybe Mexico, it's probably ugly as well, because you probably have exposure, not as much, but you probably have some exposure to these US markets, similar to what happened in 2008, where many European companies felt the contagion because of their exposure to US markets. Okay. All right. So let's talk about crypto for a minute, and then we will call it a day. So I'm going to bring up the Bitcoin chart here. So basically, we had a sell-off in Bitcoin yesterday, and I did expect this to happen. I've been talking to you about this for a few weeks. When I started talking to you about this about 2 weeks ago, we were up here in the 23,500 range, right in this range. So let's say we go back 2 weeks, that would put us at about February 24th, right? So we were in the 24,000 range. I said a pullback at that point to somewhere between 22 and 21.5, or 20,000, 20,500 is what I would have expected. We got to pull back all the way to 19,600-ish, and we're now skirting 20,000. and we're right at 19,890. We've recovered a little bit this morning. I think because the payroll numbers didn't scream higher, that probably helped. We haven't had any specific bad news from other banks yet, although the rumors are flying now. First Republic was halted, I think recently. I haven't confirmed that, but I saw a couple of messages this morning, people asking me to be on their show saying that I want to comment on First Republic. So I haven't been able to dig in yet, but I do believe that stock was halted as well. So look, so here's my take, right? Now, independent of some catastrophe taking hold of risk on assets, this is exactly what we want to see. We want to see Bitcoin bounce off 20,000, right? Coil like a rubber band and scream to 30,000. That is exactly the setup I was looking for. Now, I wasn't counting on Silvergate, Silicon Valley Bank, and First Republic stocks being halted trading. All banks basically with huge businesses here in Silicon Valley being either halted or going out of business at the same time. I don't think First Republic is going out of business, by the way, and I don't think Silicon Valley Bank is going out of business. I think Silicon Valley Bank is going to end up part of another bank, and I think First Republic is going to be fine. But what do I know? Okay. However, we're at where we're at, and we're in a little bit dangerous territory. Like I said, if we expected the pullback, it's not a disaster. It's actually in some ways helpful. Ethereum, looking like it's wants to. Oh, this is a nice doji forming. If we can close today at the top of this candle, 1425-ish, that is a nice reversal doji on a daily going into a weekend. Very nice. And so what we don't want to see is a collapse, of course, but it could end up being a nice reversal candle for us. So let's take a look at gold, right? Gold is screaming higher. So gold over the last 2 days, I've got some stuff in the way here, so I can't see the numbers, but gold is up 2% today, and it's recovered its losses from earlier in the week and is looking very bullish right now. Right. And that's interesting for the Bitcoin narrative as digital gold, we'll see. But, the dollar, right, at the same time, we've got the dollar, again, it was on an uptrend. It could have, major repercussions if we think that rates are going to be sustained lower. I do suspect that this downtrend on the dollar is going to continue. Nothing goes straight down. Nothing goes straight up. The dollar bounced off the lows at around 100 on the DXY and recovered to 105. I do expect it to retest the lows sometime in the next few weeks, probably in April or May. And I think that Bitcoin is going to have no choice but to go higher in that environment. That's my prediction. What do I know? I don't do TA technical analysis for a living, but I like to think that I know how this stuff works now, which is why I give you my opinion, and it's only my opinion. It's not investment advice, but it seems to make sense. Okay. So again, it looks like, look at this, right? So we had this beautiful channel forming on the spider, the S&P 500, and it is bouncing hard off that channel, right? So it touched it, bouncing up. If we get a close above this line, and then we get any kind of news that signals that the Fed or Treasury or anybody may have to step in, we might see a blip below and then scream higher, because that's going to basically equal quantitative easing in the minds of a lot of investors. Okay. It's just something to look out for. I have no idea what's going to happen. But right now, as the S&P goes, so goes crypto for the most part. Okay. So we'll see. But I think the three are correlated: the dollar, S&P, Bitcoin. You've heard Raul say it on our show, crypto is macro, macro is crypto, and that is certainly playing out right now as it relates to the banks. Okay, so let me stop there. Okay, so that was a lot in 30 minutes, and I'm going to let you absorb that. I'll be doing some Twitter spaces and answering questions as much as I can over the next few days as I stay on top of this. Abra has no exposure to Silicon Valley Bank. We have no exposure to Silvergate. We used to use Silvergate for wire processing. We stopped it. So, as it relates to U.S. banks, we have no exposure at all for any of these banks that are in the news. So I feel pretty good there. But look, it affects all of us. Okay. We are basically in this migration from the old world to the new world. And we need the old world not to break before that migration is done. And right now it is breaking. It's breaking because of the irresponsible policies of the Federal Reserve during COVID, right? The slowdowns during COVID were supply chain shocks. Supply chain shocks. They were not shocks that needed to be addressed via loose monetary policy. We are now paying the price for that excessively loose monetary policy, combined with the incredible pace of tightening that was also equally unnecessary, as we're going to see, right, in my opinion, with the sharp slowdown in the economy over the next few months. And like I said, I still predict that inflation could become deflationary, or prices could become deflationary by the end of the year, which no one else is predicting. But again, what do I know? All right. We'll see what happens. All right. So look, hope you get more sleep than the bankers are getting right now. And I wouldn't say enjoy the show, because it's not a show. It's scary. It's all of our money. It's our livelihoods. It's our country. And we need this to be fixed. We need the Fed to do its job. We need folks like Elizabeth Warren to put their eye on the real ball, which is, financial mismanagement in this country, not crypto. Crypto is your friend, Senator Warren. We're here to help. And right now, you're standing in the way of us helping. So my suggestion is that you recommend to your cohort that they start putting their eyes on the real ball, which is the existing banking system and infrastructure, which is now buckling at the seams, just like it did 15 years ago. Can't believe it's been 15 years already, but during the banking crisis when people couldn't pay their mortgage. All right. We don't want that to happen again. All right, so I'm going to stop there. If there's any major updates before next Friday, I'll step in and do a quick video. And otherwise, I'll see you next week on Money Talks. And try to enjoy your weekend. It's raining crazy cats and dogs in Silicon Valley. It's been raining pretty much nonstop since the beginning of December. I don't know how Silicon Valley is surviving this, but I've never seen this much rain in my life. I had a picture I was going to show you of the snowbanks. 50 feet, 50 feet, right? That's like, for those of you who think in meters, that's like 17 meters of snow up in Lake Tahoe. That is I can't even like put that around my mind around that number. You know what? I'm going to see if I have it here. I have this picture that I was, somebody sent me. I'll see if I can bring it up, but it is crazy what's going on in, in Silicon Valley. I mean, or in California, right? I mean, we went from, this crazy drought, which was going on for years and years, to all of a sudden, we've got, walls of snow. I mean, what is going on? Anyway, let me see if I can bring this up. Yeah, here we go. All right, so look at this. All right, here, I'll share this picture now. Remember how to use Zoom. There we go. So look at this wall of snow. This is crazy. This is California. This is not, yeah, like I said, sorry, I meant to get rid of this. Ooh, you're seeing all my personal stuff. Let me get rid of that. All right. So this is basically a 50-foot high wall of snow. How you truck out more snow is beyond me. Obviously, you can't use a snowblower because you're just blowing it into the wall. It's absolutely crazy. Anyway, if you're up in the Tahoe area, stay safe. If you're not, it's probably, and you're into skiing, it might be a good time to go. I won't be up there anytime soon, but if you are, enjoy. Anyway, enough of that. Have a great weekend and stay safe, and we will see you next week on Money Talks. Take care, everyone.